For decades, the US has leaned heavily on one tool to fuel its economy: debt. But at what point does borrowing for prosperity become borrowing for survival? From the post-WWII boom to the 2008 financial crisis, America's appetite for debt seemed endless, until it didn't. But how did we get here? And more importantly, can this trajectory be reversed? Sound familiar? In this documentary, we explore how the US leveraged its way into a looming crisis, where the lines between growth and collapse are dangerously thin. In the aftermath of World War II, the United States found itself with a choice: rebuild or ride the wave of global economic growth. The decision was clear: borrow, invest, expand. The country was at the dawn of an unprecedented era, one that would forever change the way America viewed debt. But this wasn't just a temporary fix. It was a new economic model, built on borrowed money. The war had left much of Europe in ruins, but the US economy surged ahead. Manufacturing, infrastructure, and technology, everything was in demand. American companies were poised to lead the world, and the government, flush with power and opportunity, had the means to drive it all. But to fuel this growth, the US government turned to a tried-and-true mechanism: debt. The federal government issued bonds, inviting both domestic and foreign investors to buy into America's future. It wasn't just about borrowing for the sake of it. It was about laying the foundation for long-term prosperity. Treasury securities became the cornerstone of this economic strategy. But here's the catch: borrowing wasn't just seen as a necessity, it was seen as a solution. Prosperity was no longer something earned, it was something financed. The government wasn't simply taking loans, it was investing in growth. This wasn't an era of scarcity, this was an era of limitless potential. In this new world, debt didn't have the same stigma it holds today. Instead of a burden, it was a tool. America could fund its dreams, creating a self-sustaining cycle of investment and growth. But while the economy boomed, the seeds of a dangerous myth were planted. For decades, this model worked. But the question remains: how long can you rely on borrowed money before the bill comes due? Debt wasn't always seen as a problem, it was seen as a solution. So what changed? By the 1980s, the landscape of American finance had shifted. The era of simple government bonds and modest debt was over. What came next was the rise of credit markets, complex, expansive, and seemingly unstoppable. Borrowing wasn't just for the government anymore. It was for everyone. It became ingrained in the American way of life, from the consumer to the corporation. It started with credit cards. A tool once reserved for the wealthy, credit cards were now in the hands of middle-class Americans. Banks weren't just lending money to the government or corporations, they were lending to the people. With every swipe, every loan, every mortgage, borrowing became normalized. The 1980s witnessed the rise of consumerism powered by debt. The American dream was no longer about saving, it was about spending. The house you wanted, the car you dreamed of, the vacation you craved, it was all within reach, but not through savings. No, it was through leverage, borrowing to acquire, acquiring to leverage. By the 1990s, this reliance on debt deepened. The rise of financial products like adjustable-rate mortgages and the explosion of home equity loans saw Americans borrowing more than ever before. Banks didn't see this as risky. They saw it as opportunity. Interest rates were low, debt was cheap, and the market was hungry for more. The house didn't have to be bought in full, it could be financed, and it could be refinanced. The cycle repeated. Borrow, buy, pay, repeat. But this wasn't just a consumer revolution. Corporate America was in on the act too. The 1980s were defined by leveraged buyouts, or LBOs, where companies took on massive amounts of debt to acquire other businesses. Leverage was no longer just a tool, it was a strategy to grow, expand, and dominate. Debt wasn't an obstacle, it was the path to wealth. But the more we borrowed, the more we had to pay back. Could it sustain? With every loan, the pressure mounted. The question now wasn't whether America could continue borrowing, it was whether we could continue paying. As America continued to grow, so did the reach of its debt. What began as a domestic policy soon became a global phenomenon. By the 1990s, U.S. debt was no longer just a matter for American citizens and corporations. It was central to the global economy. America's debt markets had become the most sought-after investment in the world. But why? The answer lay in one simple truth. The U.S. was too big to fail. Foreign investment in U.S. Treasury bonds became a safe bet for nations around the globe. They weren't just buying paper, they were buying stability. The U.S. dollar was the world's currency, and Treasury bonds were the safest place to park international reserves. Governments, central banks, and investors from Europe, Japan, China, and beyond flocked to U.S. debt markets. With each passing year, America's debt grew, but so did the world's reliance on it. Foreign nations didn't just invest in U.S. bonds, they invested in America's economic promises. The U.S. government's creditworthiness became synonymous with global economic health. A ripple in America's debt was no longer just a national concern, it was a global shockwave. The world had woven its own financial future into the American debt structure. This created a new kind of global economy, one that was built on debt. U.S. Treasury bonds became the benchmark for other nations' economic stability. Countries emulated America's model. Borrowing was no longer a national issue, it was a global strategy. Nations began to see debt not as a sign of weakness, but as a tool for economic growth. The more a country borrowed, the more it could expand, but this came with a cost. As the U.S. borrowed, so did the world. The economies of emerging nations, particularly in Asia, adopted debt as the key to rapid industrialization. The debt-based global economy was born, and as America's debt became the cornerstone of this global system, its influence grew along with the risks. But with so many dependent on U.S. debt, what happens when the system starts to falter? Can the world afford to watch as America's creditworthiness is questioned? By the early 2000s, the U.S. economy was on the edge of a precipice. Years of borrowing, speculative investments, and unchecked leverage had created a perfect storm. But in a system built on debt, how much is too much? It's a question that would soon be answered in catastrophic fashion. The growth of the housing market, driven by subprime mortgages, was the first sign that something had gone horribly wrong. Banks and lenders, eager to make a quick profit, began issuing risky loans to individuals who had no hope of repaying them. It wasn't just homeowners getting in over their heads, it was entire financial institutions. Mortgage-backed securities, once seen as solid investments, were now based on loans that were increasingly more likely to default. But it didn't stop there. These risky loans were bundled and sold to investors around the world, disguised as safe bets. Financial derivatives, complex instruments meant to manage risk, were instead amplifying it. The more money flowed into these products, the more investors believed they were immune to the risk of a collapse. But debt, like any other force, follows a natural law. What goes up must come down. The housing bubble was growing, but it was built on a foundation of sand. By 2008, the cracks in the system could no longer be ignored. As home values began to plummet, the mortgage-backed securities that had once seemed like gold suddenly lost their value. Banks and investment firms holding these securities were left holding the bag. The crisis spread like wildfire, triggering the collapse of major financial institutions and the most severe recession since the Great Depression. The excess of the previous decades, borrowed money, inflated housing prices, and the unchecked faith in financial instruments had finally caught up. The debt spiral that had been quietly building beneath the surface had cracked open. So, what did the world learn from the crisis, and have we truly changed? Was it the end of an era, or just a warning sign? The scars of the 2008 financial crisis were supposed to be a warning, a sign that the debt-fueled economy was unsustainable. But as history often proves, lessons learned in the past are easily forgotten in the rush for more. The aftermath of the crash should have marked a turning point, a shift in how the world approached debt. Instead, it became clear the cycle wasn't broken, it was just beginning again. Post-2008, the US government, under pressure to restore economic stability, turned once more to debt. With interest rates near zero, borrowing seemed like the only option. The Federal Reserve expanded its balance sheet with unprecedented levels of quantitative easing, flooding the economy with liquidity. The pandemic in 2020 only accelerated this trend. In the face of global economic shutdowns, the US government unleashed trillions of dollars in relief packages, unemployment benefits, stimulus checks, loans, each designed to keep the economy afloat. But like the borrowing before it, these measures didn't solve the underlying problem, they merely postponed it. As government debt reached new heights, so did consumer debt. Digital platforms made borrowing easier than ever. Apps that allowed people to buy now, pay later blurred the lines between instant gratification and long-term financial responsibility. The ease of access to credit wasn't just a shift in financial services, it was a new mindset. Debt wasn't something to avoid, it was a tool to be leveraged. At the same time, inflation was creeping in. Supply chain disruptions, rising energy prices, and a global shortage of goods were pushing the cost of living higher. But inflation isn't the only force driving the modern debt spiral. Digital assets, like cryptocurrencies and decentralized finance, DeFi, have entered the picture, offering new ways for people to borrow, lend, and speculate. This innovation, while revolutionary, is also deeply tied to a system of leverage. Without proper regulation, these digital assets could become the next big risk. The past and present are connected in ways that are hard to ignore. We've continued borrowing, financing, and leveraging in much the same way we did before. The tools have changed, but the underlying structure remains the same. With all this borrowing, the question remains, are we truly growing or just postponing the inevitable? The question that has lingered through each chapter now comes to its natural conclusion. Can the debt spiral continue indefinitely, or is the reckoning at hand? For years, America has relied on debt to fuel its economy, its government, and even its people's dreams. But as the scale of that debt grows, so does the danger it presents. The next chapter of this story may not be written in prosperity, it may be written in collapse. At the heart of this system lies a moral hazard. Trust. Trust in institutions. Trust in the belief that the system will always find a way to recover. Trust in the idea that leverage, when used right, leads to growth. But the psychology of debt is deceptive. Each new loan, each new bond builds upon the last, until it becomes too big to manage. We've come to view debt not as a potential pitfall, but as a tool for prosperity. But in reality, it's a double-edged sword. The risk is clear. Continuing down this path could lead to hyperinflation. As the government prints more money to pay off its debt, the value of that money declines. The price of goods rises, wages stagnate, and purchasing power erodes. A collapse of the bond market, the linchpin of global debt, could trigger a cascading effect that reaches every corner of the economy. But the consequences go beyond just economic instability. They go deeper into the fabric of society itself. Trust will be shattered. Financial institutions that once seemed invincible will falter. Investors, citizens, and governments that relied on the strength of U.S. debt will find themselves scrambling for stability. So what can be done to avoid a future collapse? The first step is recognizing the signs before it's too late. 3 key signals to watch. Debt to GDP ratio. A rising ratio is a clear indicator that the nation is borrowing more than it's producing. If this number keeps climbing, it signals unsustainable debt levels. Interest rates. If interest rates rise too sharply, it will become more expensive to service existing debt. Watch for sudden increases in borrowing costs. Currency devaluation. If the dollar weakens, it's a sign that the trust in U.S. debt is starting to erode. But the real question remains. If the U.S. debt spiral can teach us one thing, it's this: the price of prosperity may be higher than we're willing to pay. As we've learned, the cost of borrowing doesn't show up on the balance sheet until it's too late. So what's your take on the debt crisis? Is the system beyond repair, or can we still turn things around? Comment below. From the post-WWII economic boom to today's unprecedented debt levels, America has used borrowing as the engine for growth, prosperity, and global influence. What started as a strategic tool to rebuild after war became a self-perpetuating cycle of borrowing and spending. Over time, this reliance on debt spread beyond government bonds to corporate America and ordinary citizens, all the while creating a financial ecosystem built on leverage and trust. But as we've seen, this model can only go so far before the cracks begin to show. The 2008 financial crash was a wake-up call, yet the lessons learned were fleeting. Instead of correcting course, we doubled down. The pandemic brought another surge in borrowing, and with it, an even greater debt burden for the future. The question now isn't whether we've learned from the past. The real question is, can we change course before the inevitable collapse? The consequences of continued debt reliance, hyperinflation, market collapse, and financial instability are all too real. As the US leads the way in borrowing, the rest of the world follows suit. But with each step, the risk of a global financial crisis grows. If we continue to leverage our way through prosperity, how much longer can we delay the reckoning? How long before the debt spiral unravels? So what's next for America and the world? Are we stuck in an endless cycle, or can we break free before it's too late? Do you believe the US can continue to rely on debt to fuel its economy, or has the time for a major financial reset arrived? What do you think will happen if the debt spiral continues unchecked? Are we heading towards a global financial meltdown? If you found this video insightful, make sure to like this video, subscribe to this channel, and comment below with your thoughts. Let us know how you think we can solve the growing debt crisis. Your opinion matters. Let's keep the conversation going.